Good morning, everybody. Welcome to the Flow Show. Oh, I need to get my special guest in. One moment. I've got to ask him in. Where is he? Where is he? There he is. Let's get him promoted. Mr. K is back, but he might be a bit in the background. First day back.
Morning.
Oh, here he is. Morning, Kay. How you doing?
Morning, Ryan. Morning, everybody.
Cool. Michael's in as well. Morning, Michael.
Good morning, mate. I was worried I was going to be ostracised and left out in the cold then, but good morning to you, Ryan, and good morning, everyone else.
Morning.
I'll get you in the end, mate. Actually, the reason I brought you on is because I've had enough this week, so I'm going to go down a cafe and leave you to it, mate.
Well, I was going to say that Kay, who I was brought in as a replacement for, seems to be here, so I'm the one who's redundant, I think.
Yeah, well, I was trying to get you on early in the week, but you've been such a busy man this week.
You know what it's like, mate.
Doing your Ron Burgundy impressions all around the airwaves. So, got you today instead.
Stay around so I can just ease in smoothly.
Exactly. Right, let's get going. Oh, bloody Thursday. I wish it was bloody Friday. It's been one of them days again. The old market washing machine is on. Stuff up, stuff down, stuff all over the place. Right, let's get going. Anyway, let's get rid of my mugshot first. Make it easier on the viewers. Right, Japan. Been reported that PM Ishiba said that there's a major gap in stance between the US and Japan regarding all this trade stuff. So doesn't look like we're heading for a quick conclusion there. These guys are still looking towards meeting on the sidelines of the G7, which is this weekend, if I'm not mistaken. Is it this weekend, mate? Anyone?
Sorry, I was hoping to have furiously Googled that by the time you asked. Yes, it is this weekend.
It is this weekend. Great. So we've got a load of waffle coming out of that. So that's going to be a busy Flow show on Monday, listing all those headlines. Anyway, that's it's potential, obviously, for some weekend risk then if trade deals are not together or headlines come out of that this weekend regarding trade. Moving on to the Bank of France, things are going so well over there. They've now cut their forecast again, this time for 2026 down to 1% from 1.2 and 2027 1.2 from 1.3. Head of the Bank of France, Victor Villeroy, says the ECB situation is favourable, but doesn't mean that policy is static. Doesn't see deflation, but the ECB has tools to react, and that the Trump admin caused chaos, which is weighing on global growth. So pretty damning there from the Frenchman. ECB Simcus says the ECB has arrived at the neutral level of rates. Another victory lap going on there. But then says inflation may be lower than the target in the medium term. So expecting some softness coming up from that. Rachel Reeves proclaimed yesterday that the UK is the fastest growing economy in the G7. Not this morning, not 24 hours later. GDP for April, so the first monthly number in Q2, came in at minus 0.3%. Was expected to come in at minus 0.1%, to which she proclaimed this morning it was very disappointing. Mike, I know you got stuck into the Reeves stuff yesterday. This is obviously, they all do it, all these politicians do it, proclaim decent Q1 numbers and then try and ignore when it all falls off a cliff. But more importantly, is this going to be the start of what we're going to see in a lot of GDP numbers, where we had that trade boost in Q1 that's going to wear thin in Q2?
Yeah, absolutely. I think you've hit the nail on the head there. Obviously, all of the import front running into the US has a positive impact on GDP elsewhere, which boosted the Q1 numbers. The other thing to bear in mind with the UK data specifically is there were a few other changes that went in at the start of April. The stamp duty threshold was lowered, so effectively people paying more tax on property transactions. The same thing goes for vehicle taxes, and also the same in terms of national insurance, which went up at the start of April. So effectively, what you've got here is March was boosted by activity being brought forward ahead of all those changes, and then we've just given it back in April. But I think it's going to be, or the way I've framed it this morning is a soft number, which starts probably a soft second quarter, given certainly given the jobs data that we had out earlier in the week.
Yeah, absolutely, mate. And well, it was the Bank of Canada, Macklem, who mentioned it a week or so ago, saying as well that they borrowed growth in Q1 that they're probably going to give back in Q2. So this is probably going to be what we're going to be watching for the rest of this quarter at least.
But it's okay, because I'm sure that Rachel Reeves has got a plan to get us out of this mess.
Yeah. Oh, billions. She's got billions in plans. If she can fill this 22 billion black hole, of course, which is still there. Don't get me started, mate. Don't get me started.
You brought it up.
Go on.
You brought it up.
Yeah, I'm my own worst enemy sometimes. I put on Parliament TV yesterday, and in the first line she mentioned the 22 billion black hole, and I switched it off. I was like, no, I'm not through that crap. But anyway, let's move on quickly before we start booting our TV screens in. Right, going to look at the data from yesterday, starting with the US CPI data. Now, I seem to have, as usual, a different opinion to everyone else. The data was soft-ish, depending on what you're looking at. CPI coming in at 2.4% year on year, which was up over last month. The core coming in unchanged in the end at 2.8%. Nothing bearish there, nothing deflationary there. We got some slight misses in the monthly numbers to what was expected, 0.1 versus 0.3 in the core, 0.1 versus 0.2 in the headline number. Now, I was expecting soft numbers to hit the market harder than hot numbers, and I certainly wasn't expecting the reaction we got. Just to keep Michael happy, looking at the 3 decimal place numbers, the super core month on month came in at 0.06 whatever percent versus a prior 0.209%. The year on year number, though, went up 2.862 versus 2.743. I think one of the other swingers, perhaps, for that data was the average hourly earnings, which came in at 1.4 versus a prior 1.5, and weekly earnings also dropping to 1.5 from 1.8, so a little bit soft there. So, Michael, why did the market fall out of bed on these marginally softer numbers? Was it that it was expecting hotter numbers?
Yeah, I mean, I think it's very much a case of, we can look at it and we can go, the inflation data is softer than expected, which it clearly was. But at the same time, we're also all sat there, and the very next thing we ask is, okay, well, tariffs have to show up at some point. So if it's not this month, it will probably be next month. And is it going to show up in a slightly uglier way next month when those costs do end up getting passed on to the consumer? So it's very much a case of, fine, inflation hasn't risen by as much as we would have expected just yet, but we all know it's going to, and certainly from a policy perspective, it really doesn't change the outlook in any sort of material fashion. No one at the FOMC is going to look at that and go, okay, we can sound the all clear now. Price risks are still very much to the upside. So fundamentally, it's good news, but it's not going to make much difference in the grand scheme of things.
No, exactly. But then why did we get such a market reaction then? We saw quite a stiff sell-off in the dollar, yields as well. Is that just the market just still wanting the Fed to get back on the cut path?
Yeah, I think it is. I mean, it was. I think it's also a sign that the market was probably positioned for a relatively hot print, and we didn't get that. Maybe at the margin it reinforces the idea that we're going to get a couple of cuts by year end. That's certainly what the market is back to pricing now. The other thing is, you look at where treasuries were trading from a yield perspective, certainly at the long end. The 10-year had tagged that 4.5% mark again. The 30-year was up close to 5%. They have been levels where dip buyers have been quite interested in recent weeks. So when you get that yield, you also get the soft CPI data. It's kind of that perfect invitation for those participants to come back and enter the fray. But I do think we've probably got a bit far on that dovish repricing now. 51 basis points in the OIS curve by year end. If you think the Fed are on hold until Q4, it's a bit ambitious in my mind that they'll deliver what the market is now discounting.
Yeah, absolutely, my friend. Mr. Trump obviously had to come out and comment on the numbers, saying that they were great numbers and that the Fed should now go and lower rates by 1 full point. No surprise he came out with those comments. Mr. Powell probably sitting in his office going, jog on.
Do you know what I think is interesting about that, though?
Go on.
Obviously, they're not going to deliver a 100 basis point cut. That's, complete and utter nonsense. But Trump is kind of saying the quiet bit out loud now, because the next sentence in his tweet or truth was, "We would pay much less interest on our debt coming due. This is so important." So it's very much a case of Trump sort of overtly and explicitly trying to blur the lines of monetary policy independence even more than they were before.
Yeah, absolutely. Yeah, no, you're 100% right on that. But that's assuming that Trump knows how interest payments work in terms of rates and the rest of it. So, I'll leave that open to interpretation. Anyway, sticking with Trump, moving on to all the trade stuff. He came out and said, our deal with China is done. We are getting a total of 55% tariffs. China is getting 10%. Now, that 55% is broken down between the different bum fights that they're having on that, fentanyl and this, that, and the other. So that total 55% is across 4 different things. China put out a message saying that they are putting a 6-month limit on their easing of rare earth export licenses. So they're happy to get that ball rolling back with the US, but it's only on a 6-month timeline because they're not going to go too far out on a limb, considering there's lots more to be done with this China deal. We haven't really even got into the super nuts of everything to do with that. But that hasn't stopped the US bods all coming out and proclaiming victory from the rooftops, saying, Lutnick, saying we're now focusing on other deals. Deal after deal will start coming next week. But then said Europe was more than thorny in trade talks, and that they will probably be at the very, very end of getting deals done. Treasury Secretary Besant was also waxing lyrical about China, but he did mention that whether they agree to adhere to all this new stuff remains to be seen. But speaking on the rest of the trade stuff, so trade deadlines could be extended for countries negotiating in good faith, and possible tariff relief will come for countries negotiating fairly, saying that Trump is likely to push back the July tariff deadline, which not really a surprise. But
you could knock me down with a feather.
Yeah, exactly. But the fact he came out with it anyway was something. But then Trump decided to get involved. He said, trade talks are progressing. We may not need a deadline extension. We're engaged with Japan, South Korea on trade. Says we're willing to extend the deadline, but he sees no need. Then he sort of he plays good cop, bad cop in a one-man show at the moment. He said, take it or leave it letters will be sent in 1.5 weeks. Says EU is keen to negotiate and we'll reassess in a week. We'll set unilateral tariff rates within 2 weeks. And he's going to send trade letters to other countries in 1 to 2 weeks. So he went from saying, yeah, we might extend to, I'm going to start throwing tariffs out in 2 weeks. Where does that leave us, Michael? Apart from the market shitting the bed again.
No, I genuinely don't think it changes things one tiny little bit. I mean, if you just sort of break down what you've said, talking about the deadlines being extended, I mean, I think probably every deadline that's ever been set in Trump's life has been extended at one point or another, certainly on the issue of trade. So that's not particularly surprising. Then there's this issue of, the sort of take it or leave it, we'll set a price kind of stuff. Well, that's not new. That Trump has been saying that. I went back and looked at headlines this morning. Trump's been saying that since the middle of April, that at some point, if we can't do a deal, we're just going to give you a number and that's going to be your tariff. Sort of the sequel to Liberation Day, if you will. But again, you would sort of sit there and go, well, that's just a case of he'll end up using that as negotiating leverage, exactly as we saw a couple of weeks ago with we're going to throw a 50% tariff on the EU. The only reason they said that was to hurry things along and get the EU on the phone and give them a bit of a kick. So I don't think it really changes anything at all, to be honest. I think the broader direction of travel is still towards agreements being done, whether they're comprehensive agreements or simply frameworks for more talks. I think the big sort of overarching factor is the US have shown, I should say, that they simply don't want to or perhaps aren't able to stomach incredibly high tariffs of the ilk that we saw at the start of April. So I certainly don't think we're going back to those days anytime soon.
I fully agree with that. And yes, wider picture, yeah, we're still headed towards trade deals. But as we often say, markets are like goldfish. They've only got a 7-second memory or 30-second memory, whatever it is. And, 1 minute, everything's tickety-boo, we've got trade deals coming, so on and so forth. And the next minute he's saying, right, well, no, tariffs are coming and the market throws a bit of a hissy fit. If you take the long-term picture, if the market's thinking, oh, we shouldn't be worried about what he's saying, why is euro dollar trading up through 115 at the moment, nearly up towards 116? Would you be a seller up here?
Well, I'm slightly annoyed you asked that because I was literally about to ask you the same question. Which is slightly annoying. As long as there's no lunch riding on my answer to this, let me caveat with that first. I think what's interesting is, again, the vibe in the market is not necessarily a case of risk on, risk off. It's a case of buy America or sell America. And, we see the tariff noise ramp up and we see the sell America trade ramp up. That's effectively what we're seeing. Would I want to step in front of this move in the euro here? Absolutely not. I mean, what are we now? About 15 pips off year-to-date highs. It's not exactly screaming at me that you'd fade this move here, particularly when, if you set trade aside, every man and his dog at the ECB is out on the wires this morning saying that the easing cycle is done. The market is pricing a more dovish Fed. I think you'd really want to wait and see if this formed a bit of a top before getting in the way, because it just feels like we're gunning for a test and probably a break of those year-to-date highs at this point.
Yeah, I think you might be right about that one. Technically, it's been a solid break. So I'm just looking because Lagarde is out. Nothing really of note. Global economy has faced incredible shocks. Blah blah blah.
Thanks for that.
No, nothing massive to her. Okay, we'll look at the euro in more detail in a moment. Trump sort of got some good news as well. Yesterday, the Federal Appeals Court ruled that the US can use their tariffs, or he can use their tariffs to protect itself against other countries. One other thing that's playing around in markets a lot at the moment is this Iran deal, no deal stuff going on. We keep swinging between the positive and the negative. What's negative is that US is moving personnel out of several Middle Eastern states. Israel was also out saying they're ready to go, basically piling in to Iran, whether the US wants them to or not. So this is all coming to a bit of a head. 1 minute Iran saying it's all happy to get a deal done and it can happen pretty quickly. The next it's all going wrong and Trump saying things are turning sour. We've got this summit Sunday, I think it is now, or this weekend, where we may get a deal or we may not. Whether a no deal leads to bigger things like Israel taking action remains to be seen. But this is all playing into, as Marco said, we've got what we call a US risk on, risk off, but we've also got wider risk on, risk off with this Iran stuff going on. So there's lots of irons in the fire with this one. How do you see this Iran stuff impacting, Michael? Obviously, we're seeing oil pushing up again.
Yeah, well, I mean, it's of the initial reaction last night when all of this started sort of kicking off, or at least the volume of reporting around it picked up, was as you'd expect. Risk a chunk lower, gold higher, crude higher. My inclination with any of this sort of geopolitical flare up is always to be patient, but ultimately expect that the moves will fizzle out in relatively short order. It's obviously something that's going to play on market participants' minds a little bit, but frankly, I don't think anything here is really going to be particularly sustained, at least not in the equity complex. Maybe it'll put a floor under crude, but I think we have gone a little bit too far too fast, at least with WTI up at what, $69 a barrel overnight.
Yeah, very much so. Right, that's it on the headline front. That's all I could be bothered to write down anyway. Michael, got anything else you think we need to know about?
Do I have anything else we need to talk about? Not in particular. We covered off the UK GDP numbers, obviously, all of the trade nonsense. I think we've done a very good job there, mate.
Cool. Thank you very much, mate. Thank you very much. Right, today we've got PPI data, which is going to be a bit of a follow-up to the CPI data yesterday. So that's about all the numbers we got coming out from the US. Obviously, jobless claims, which has been ticking up a little bit, not to any sort of worrying levels that I'll be bothered about, but we're in this mode where any bad news is jumped upon. So even if we get, a 249 or 250 initial jobless claims, that's going to see the market reacting. PPI can be a bit more of a volatile beast than CPI, so we could see some bigger swings going on here. And it'll be interesting to see whether it follows the CPI data or it goes the other way. And perhaps this is where we might see some of that inflationary impact, because it will be seen in PPI before it's seen in CPI. So this sometimes can be a bit of a leader. Yes, mate.
No, I was going to say, I was, just as you were saying that, I was thinking, I think the usual PPI lead CPI thing is going to start to break down as a result of these tariffs, because what you're actually seeing is, the tariffs are, a lot of it is being applied to finished goods that are just shipped into the US and then sold straight away. And if they're just sold at a higher price, then that's going to feed straight through into CPI, or at least in a much shorter time frame than the usual lags that we would operate with. But at the same time, the PPI numbers do still feed into expectations for PCE. So that's worth bearing in mind as well.
Yeah, well, that's just made the case that it's going to be another big old mess to look forward to. So well done there. Thanks for that, Michael. Right, okay, let's get stuck in some prices. And if Mr. K is ready to come in, because we were talking about the euro this morning. And
yeah, I'm kind of ready, mate.
Regarding the ECB, they haven't said much about it. They had a chance to last week at the ECB meeting and didn't. The Guard yesterday as well, coming out with comments that they're not that bothered at the moment. So where is the pain level for the ECB and all this movement into the euro?
I don't think you can stick a rate on unless this market flies straight away to or even past 120 or so. But no, the thing was, and I was thinking when you guys were talking about why the dollar got sold. Actually, it's accelerating now. Euro is already breaking the prior high. I think there's a combination there going on. Is that obviously the fragility of America now, because of all those Trump 180s or whatever, the market lacks confidence in the US. And then already from before the ECB, we were talking about that, especially, of course, the Hawks. But now we even heard from Villarroel this morning that he thinks that monetary policy in Europe could be in a good place. So we have this combination of, all right, I mean, Trump, and he actually won a lower dollar, but it is like lack of confidence in the US, and then you have like European data not getting worse anymore, let's call it that. And then the the ECB bots not fighting against money flowing into Europe, and that's instead of like looking at really the strength of a currency, it's actually money flows, and if you flow from the biggest block into the second big block, that is what you really get. And perhaps the market was like looking at those inflation numbers yesterday and saying like, okay, I mean, there was fear for perhaps a bit of a spike on the back of those tariffs and Trump's we don't know what we are going to do, but it's going to be painful for you, whatever happens. And all of that came together, and then yeah, the market went like, okay, now we can sell dollars again because there is not the CPI scare, which we need to take into account, taking the US yields back higher, so that weighted or went away, and that's why we see this flight, especially in the euro, because like, compared to what they were doing before, they are not fighting this move higher in the euro, and they're actually welcoming the flows and the money flows into euro because not let's not forget that they are also going to spend a lot, right? Germany in the lead, so it's always better if you get money flowing into your block, and then when you are crying for money and then needing to fund it to fund the increased spending. So everything points at the euro as a currency being in a relatively good place. There's a few others, and then there's the risk trade still, which we sometimes find back in the metals, but less so right now. But especially the euro is taking advantage of all of this, and that's why I think it can actually continue for a little bit.
This
Yeah.
is all going to start to cause the ECB quite a bit of a headache, though, I would imagine,
Or
in
inflation, you
relatively
mean?
short order. On inflation, yeah. I mean, I'm just looking at the June forecasts now, and we're
Mm,
already at so 2026 inflation. They already projected it at 1.6%, but that was
yeah.
based on the euro at 113.
Mm,
So if you look at, if the euro moves to, well, we're basically 116 now, if we get up to 117, 118, you're looking at CPI undershooting the inflation aim, if we stay there, of course, by, not far off 1% next year.
mm. I thought it was like, what is it like 3-4% in the currency is having already a material impact on CPI. Obviously, if we compare it to the 102 that we were at beginning of April, I mean we are like 12-13% higher. So that will have a material impact on inflation. But the thing is as well, we know that ECB has a price stability mandate, right? So yes, if inflation comes down, they are more likely to cut rates. But personally, I really think that there is an untold part to the mandate, and that is growth and just economic stability rather than inflation. In the US, it's clearer this dual mandate, but we hear Lagarde and the others talk a lot about the risks to growth, the outlook to the economy. So there's a bit of an untold part of the mandate there, which
Hmm.
I think today they are relatively happy. Today they are relatively happy to see those inflows in the euro. And if it would weigh a bit on inflation, will they not let inflation undershoot for a while until they know exactly what's going to happen to the economies?
Yeah, I think the other slightly unspoken thing in all of this is not just with the euro, but we see it particularly with some of the Asian currencies, is just a little bit of a nod towards Mr. Trump, who is after a weaker dollar,
Mm,
and not stepping in the way of that slow and steady dollar weakness is
mm.
probably a way to get on his slightly more positive side.
Yeah, yeah.
So that
Mm,
yeah, so I mean the question I've got, I mean I need to go and find this bloody Draghi quote that keeps bugging me. But he put numbers on, X amount of movement in the euro equals X amount in CPI and inflation. I need to go and dig that up. But you say
was it not? I mean to recall something like 10% in the currency is 1% in CPI.
I can't remember if it was 1% or 0.4 or 40 basis points. I can't remember what it was. I really can't. I know we had this discussion the other week as well. I really need to go and dig it up just to clarify. But either way, I think that's the issue that you've raised, Kay, saying that will they be happy to see inflation undershooting for a while? That's the problem with them. They think it's going to be temporary, and the chances are that it's not, because there's no economic activity to offset what happens in the currency in weakening inflation. Look at France. Look at inflation in France. Miles below 2%, and firms still cutting costs. So I think this is where I think the ECB is going to get caught on the wrong foot if they're happy and say, any blip below target is going to be temporary. That's where I think they're going to get egg on their face potentially, because as we know, inflation is an untamable beast, and if it wants to go lower, it's going lower, whatever they do.
Yeah, but on the other hand, they already lowered the interest rates quite a bit, right? So yeah, I don't know if they would see it we as if we just commentate and leave our traders like having like actual positions a bit aside, we can say like, okay, there comes the next mistake by the central banks. But then when the dust settles, those mistakes they're handled with, and the bond market will do with it what they want or what they need to do. I think that they are willing to sit it out for a while, because we haven't seen the real impact of all that spending that is now being touted in the euro area. Again, Germany in the lead, but everybody is willing to spend more on defense and stuff. We haven't seen the impact on the economy yet, right? So that could be something for Q3, Q4 this year, and maybe the ECB is just going to be patient and willing to, between brackets, make that mistake, but just wait for things to pan out. And if by then there is no real economic impact, then we are going to see another series of rate cuts, obviously, right? Because if you see increased activity somewhere, it has the kind of impact to push up prices a little bit. Because if you say, for instance, Germany needs to spend, how much is it, like 100, 150 or so, or I don't know how much on just on infrastructure, it's going to push up prices somewhere, right? Because they are going to need to buy all that material and base materials to start building all that thing. So if the ECB might just be waiting for that to happen, and then in the meantime, just let us commentators tell them they make a mistake, but just move on afterwards.
Yeah, it's all very possible. But back to your first point, I'm very much book talking. Though my book is looking a bit shit at the moment, being short euro sterling. I think I've had a crocker in that one. Trading my ECB plan. The market's certainly taking the euro way up. Anyway, let's have a look at the euro. I just want to show the wide picture in the euro first, to get some of these big levels on the table. I know a lot of people in our chat room are looking at 116 and a half, and absolutely see the merits there. For me, I'm more 117 and 119, and then 120 is going to be big above. I think we're going to be in barrier territory with this move above 115, because we haven't been up here for quite some time. So I would expect to start hearing about some barrier action going on at the big figures and half figures up to 120, if not further. You can see that 120.20 is going to be a bigger old level, because it is the 38.2 of this massive move as well. So big old text coming up. We're getting into some real big historical stuff going on up here. Okay, 115 was big enough, but some of these others are just as big and as valid. So keep your eye on the wider picture. as well as what's going on in the short term. Going back to the short term, and as I was mentioning in the chat room, you couldn't get a more perfect technical break of this. We hit it the other day, we hit it again, little pullback, and then we've blown through, and it's now support. So this 115, whatever happens now, this 115 is going to be your key level. Whether we see it again for a couple of years, or whether we're going to just keep flying, remains to be seen. But if we do get any news, any change in sentiment, and we get a test back here, keep an eye on that one, as we should keep an eye just now on this former high that's now been broken, just to see if it shows up with any support, because that will look another bullish move. We're just underneath it again, so we've had probably a little bit of a stop run through there, hitting some big figure numbers offers. We're back below, so you've got two real key levels at the moment to keep an eye on. We get above here and hold it, we're probably going to put in a knock on that 116, but don't be surprised if we see a bit of action 115, 90, 95, and if there's any barriers going on up there. What else?
The thing is as well, Ryan, it's not only euro dollar. If you look at the rest of the dollars, they are relatively subdued. We've been trading a lot of those levels already. Okay, cable is a bit higher as well, but if you look at Aussie, Kiwi, even to a certain extent the Canadians and stuff like that, they're not massively moving. All the euro crosses are a lot higher, and so that is what I was talking about as well, and what we've been saying, the attraction of the euro. People are putting money in the eurozone, and that is obviously pushing euro dollar higher, but it's also pushing all the euro crosses higher. If it would be a pure dollar thing, you would, I would suspect, find Aussie, Kiwi at different levels as well, but we don't. It is really the euro.
Yeah, absolutely, mate. And I don't know, some might say out the frying pan into the fire if they run into the euro for safety. But it is what it is. Markets are going to do what markets going to do. Yeah, I was going to look at Aussie dollar. This looked like it might be able to go on the upside. I was a bit cautious. I've been talking about buy stops. I'm glad I didn't bother, even though I probably would have stuck it above this 50 area, above this fib. But we've had a little move down to support 64.80, so it's not doing an awful lot. So it's not pulling back too far, but as Kay said, it's not following what is going on elsewhere. Little bit of influence probably from Euro Aussie on this one. So as Kay mentioned, look at the crosses for what's going on here. We did see a bit of a blip out in gold. I don't know if that was part of a little bit of a precious metals washout, but it's recovered back anyway. Before I look at that, Aussie dollar, we're not out the woods in potentially going for a break higher. I'm more inclined to trust a break now than trying to see what happens over yesterday's CPI report. But if we're getting under 80, we're probably going to see a steeper pullback, because I reckon there's a lot of short-termers long around this level. And if we get a bit of a flush out, they're going to head to the exit, and that's when you see a steeper pullback. And then I'm potentially going to be looking with interest at this 64.40-45 level again, which is that break point that finally looks like it might be the one that goes. But yeah, it's still a bit of a two-way coin, but I think the bias is still for further upside on this one once the influence from those crosses come out. Dollar MEX I want to look at quickly. Really got a flush out of this 19 area. Let's go into the cleaner chart, might help. So we've had this break under 19 now. It took a while to get there, and then it took 5 minutes to really flush it out. We've opened the day below this 19 level, so this is the key level for dollar MEX today. Stay below there, then we're going to be heading lower. But if we get above there today and then hold and close above it today, it might indicate that this move since the 1980s is going to perhaps see a little bit of a pullback or a little bit of a retrace, because this is a fairly decent level. So if we're back above there, this might look like a bit of a fake out. Conversely, if we're staying below, then I'm fingers crossed for a move down to the big old 1850, and I may even decide to flip it long if we get down there, but we need to get through this 50 retracement first at 1877. So nothing goes the same way forever. Okay, so this has been a big strong move, and it's just got my antenna up that bounces have been limited, and that's going to reverse at some point. Doesn't mean we're going all the way back to 20, but it means we might get a move back into the 1950s, maybe up towards 60, 70, 80, something like that. So don't rule it out. Ping. What else was else? Derege, Kiwi. I bet that's not going to show too dissimilar picture to the Aussie. Yeah, failure up here at the zone, but we're not pulling back too far. So really your supports, you've got several levels. I've got several levels down here. The big ones, obviously, if we get down to this 58, 70, 40 zone, that's going to be the big one. But we got the minor levels in between 60, 30s, 59, 90s, 60s, that sort of thing. We're not turning around this trend at all. Even since May, this is still well entrenched. So if you get over this noise, maybe, euro eases off a bit, then this one might be heading back higher again. But it's certainly still looking positive, Mr. Derege. Kay, you ready to have a look at anything, or you want me to continue?
No, go on. I'm looking at the time. I mean, Brian was asking about the cable. I think cable, the top side is still 136, mate. If we need to get above and hold, that's a relatively simple thing. We've had this on last Thursday. We had a quick run through 136 and then completely came down again. It's still 136. It's pretty simple on the cable. We are just getting there slowly again. But again, I mean, looking at that euro sterling pushing through now, it's all going to go slower than the euro. I reckon. Also meaning that if the euro finds resistance, of course, euro crosses will probably find some resistance as well. But if euro dollar would come down, maybe the other dollar pairs will come down faster, and I would be a little careful on the cable. If we start to get back below 135 and a quarter or so, that thing is probably a bit at risk of getting a move back down in that 134s. Yeah, as you were showing there, I mean, euro sterling. I mean, we were thinking about it before I left, and saying that because I covered my shorts and saying that, well, we don't know what's going to happen with those data and with Reeves upcoming, and here we are. The market went a bit, how shall I say, emotional about the sterling again, and gave it a pretty big knock on the head on versus euro at least.
Yeah, we had that shitty jobs report number out, and obviously we've got the Bank of England next week. So this is a perfect storm, flows into Europe, and the market getting a bit bearish on the UK again.
Yeah.
So yeah, that's why I'm caught out on this one. So I'm going to be wearing that one, I think, if it continues. Back to cable, just keep an eye on this though. Obviously, euro's breaking to new highs, but we've got this thing that I like to look for. Okay, we've had this prior high. We had the high broken, and now we're respecting that prior high. I don't like the fact that there's not much space between there. What are we talking? Few pips, 20 odd pips between these highs. So it's not as clean a move as I like with me 1, 2, 3 move. But this could be significant. If we hold here, then we're probably going to get a move back down, maybe to the low 135s again, if not down to 134.5 again. So just keep an eye on this level here. Okay, we've had the high, we've broken the high, now respecting the first high, which is a pattern I like to look out for. So watch that one. Michael, you've been a bit quiet. What's your thoughts on cable at the moment, or the pound in general?
Oh, I have, mate. So I think you two have been handling things very ably indeed. There was let me put my feet up a little bit.
Mate. get stuck in.
No, I would fully agree with that. I think that 136 region is going to be key, and we're obviously coming up on another test of it now. Very much a similar story with the euro, actually. If we break and hold above, then you'd expect the market to push on. I just don't see a bull case for the pound at this point, to be completely honest. When you think about not only in terms of where the economy is, obviously this week's data has been terrible, but also what that means in terms of the BOE. The market's still only pricing 50 basis points of cuts by the end of the year, which to me seems far too hawkish in terms of what the market's currently discounted. So if indeed the BOE, we're expecting them to be on hold next week, but they're going to have to deliver, you would imagine, more than the market is pricing in, and that should be a fairly chunky headwind for the pound. So I think sterling might be getting a little bit ahead of itself.
Yep, absolutely, mate. But that's a different sterling to this one, cable. So it just shows you that cable's all about what's going on in the dollar more than what's going on in the quid at the moment.
Indeed.
Right. Anyway, thank you very much, sir, for coming and joining us on the show, Michael. Always a pleasure to have you.
And thank you for having me, mate.
Yeah, you can always catch Michael most mornings when Ryan number 2's around on Peak Suite on his morning blast, 8:30 in the morning. So you can always check into that. And you can also give Michael some grief about his really bad puns on Twitter at what's your thing? At Mr. M Brown is your handle, but most people I think know you anyway.
Probably sick of me by now.
You said it, which means I didn't have to. Thanks, Kay, as well. Welcome back, mate.
Cheers, Ryan. Nice to have you on board as well, Mr. Brown.
No, thanks for having me, mate.
Cheers, and no doubt Mr. Kay will be back to full steam tomorrow. So, right,
aye.
Anyway, that's it. We're done. Have a great day, everybody. Trade safe. Thanks for coming and watching us here, and we will see you tomorrow, Friday. Yay, pub time. Have a good one.
Bye-bye.